A lot of people get very excited and they want to jump right in, especially when they're seeing things moving around. But I think it's important to step back, take your time and really go through your analysis, because that will help you really understand what's trading, what's going on, how it's impacting the markets.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everyone. This is Jeff Praissman with IBKR Podcast. It's my pleasure to welcome to the IBKR Podcast studio from Market Chameleon, Will McBride and Dmitry Pargamanik. Hey, guys. How are you?
Hey, Jeff. Thanks for having us.
Thanks for having us as always, Jeff.
Oh, my pleasure. And we just wrapped up our monthly webinar, and it's always great to have you, whether it's a deeper dive or a different dive into the same subject on our podcast channel. So it was a great webinar you guys just did on single leg option analysis. Let's kind of just start, though, with kind of the beginning. You need a hypothesis. So, what type of questions are we trying to answer with single leg option analysis?
So when we look at option volumes, it's not quite the same as stock volume, because underneath the option volume, we have different types of option contracts. We have different expirations, we have different strikes, we have calls, we have puts. So we'd have to look at that volume, break it down, and then we start asking ourselves certain questions. And I would say the top three questions that I usually have are: what are people doing and why might they be doing it? How is it impacting the markets? And is there a trading opportunity? Now, to answer those questions, we're probably going to have a lot of different questions to lead up to those answers. But those would be the top three questions that at least I have and that we typically see. And just to get to that point, what we cover is what type of questions can you ask to get there?
And, with any analysis, obviously data is the key core point of that. So for single leg option analysis, what data points are you guys concentrating on?
So there are two types of data analysis that we do. First, you want to collect the raw data that is observable, and it'll be things such as time in sales, the open interest, the volume of the trades, the price of the underlying, the price that things traded at. And you take that data, you input it into your database, and you go through a process that you have to clean the data, prepare it for analysis, process it, and bucket it. And then you use that data to run it through a different model that answers different types of questions. And there could be simple questions that you could just run summary statistics, like what is the 30-day average volume, and you could compare that to today's volume if you take the daily average versus today, and then you could make a comparison if today's volume is high or low, for example. But there are other types of models that they're not looking only at actual data, but they're making an inference of this is what is most likely going on. And an example would be a model that may say that most of the trading in this option are retail investors, and they are targeting this option, and you can make an inference because of this news or this newsletter that came out. And those are models that are based on inferences, because we don't have that exact data point of everybody's name and their intent, but we could kind of infer it from the trading and the trade size and how they're coming in. So those are the things that we typically do, is take that raw data and run them through models, different models that try to answer different questions.
That's a really good point you've just made, because you started off describing actual data, such as time in sales, open interest, volume, the price of the underlying during the trade. Like all those are in black and white, actual data points. And I really like the fact that you started discussing inferred as well, because, for example, if something traded mid-market, right? Like if it traded on the bid, you can easily say the person sold it. If it traded on the ask, you can kind of say that the trader came in and bought it off the market maker. But what if it traded mid-market with this inferred data? How do you look at something like that if it's $1 or $1.10 and it traded $1.05? What are some key points that you can look at after the fact to sort of make an educated guess or give yourself better odds of inferring which way it went?
That's a good point. A lot of our customers, we look at the order flow. Are the orders coming in from the buy side or the sell side? Because then you get an idea of how people are using options. Because every trade has a buyer and seller, but we're trying to infer what was the initiating order coming in, right, into the market. In your example, if we just use the bid and offer and assume that that was the broker-dealer quote, okay? Let's say we determined that that was the broker-dealer quote and it traded mid-market. Well, there's no way to know if the incoming order from that is just coming in to buy or sell, but we can use other data points to try to infer that. For an example, we could take a look at how did the trades and the prices tick prior to that. So, for example, if we see that there is a trend where every trade is ticking up, the implied volatility, the price, and this happened to continue on that path, then we can infer that there are buyers pushing up the market. Even though it traded in the mid-market, we could compare it to prior ticks. We could also compare that to ticks post-trade. Another way to make that inference is by looking at the options at that moment surrounding that particular contract. We could look at the strikes below, the strikes above, and make an inference by where the implied volatility is trading relative to where the implied volatilities are set with the options surrounding it. For example, the corresponding put, the call above, or the call below. And by doing that analysis, we could many times draw a conclusion or an inference that this is the most likely order flow moving in the direction of either the buy side or sell side.
And throughout our webinars and podcasts, we've discussed single leg options, multi-leg options. When you're looking at this data, you see a call, like how can you tell it's just that call, or can you tell if it's part of, say, like a vertical spread or a calendar spread?
Fortunately, that's one of the details that is provided on the trade tape. When a particular contract is part of a multi-leg contract, that detail is disseminated by the OPR feed. So if you have a multi-leg trade on a contract, it'll tell you this is part of a multi-leg trade. The problem is it doesn't tell you what were the other legs that were related to it. It would be up to you to find it. However, for single leg trades, it wouldn't be a problem, because if it's not tagged multi-leg, it'll be tagged as like a regular trade or auto execution. And this way, it's easier to section off the single leg trades.
What percentage of like overall option orders are single leg versus multi-leg?
When we look at the single leg versus multi-leg, we could look at it from the volume side of it and from the amount of trades. So, for example, one trade could have one contract, or one trade could have 1,000 contracts, and the volume, would be 1,000 or one, but these are two trades. And if we look at just the volume, we see that about 55% overall across the board, 55% are single leg trades. And part of that is because multi-leg trades involve more contracts usually. Spread will have at least two contracts, but usually they're bigger in size. If we look at the trades on a typical day, 80% of the orders or the trades are coming from single leg. And that's because a lot of smaller retail customers tend to use single leg trades as their preference.
When looking at these single orders, how do you use the trade conditions to sort of help analyze that order as well? Whether a trade on the floor versus electronic, does that kind of help you tell a story as well, or kind of help you with your analysis?
Yeah, definitely. You could also analyze and section off the trades by their trade conditions. So, for example, a floor trade, well, that implies that that was a negotiated trade that involved human touch. It happened through probably a broker who went down to the exchange and tried to negotiate either with the market makers and the specialists or found the other side. And that happens to be a negotiated trade. And we have some of those floor trades, and they tend to be in bigger size. Most orders nowadays, though, do get filled electronically. But even in the electronic world, there are different ways that orders could get executed. For example, sometimes you see intermarket sweeps, which are aggressive orders, which could also just tell us that somebody was really seeking an execution and willing to sweep the book on the BBOs. And then you have what they call like price improvement auctions. And those indicate that an order was stopped and flashed to the market makers and specialists to seek a price improvement. And usually they do get a price improvement. So instead of an order that could have been marketable and maybe taking the ask or hitting the bid, may have even received additional price improvement. So those are things that we could take a look at, analyze, and that helps us to see how things traded in that particular option. Those details are given to us. But we could also create buckets of categories in options. And I'll give you an example where one of the things we do is look at an option, we look at the trade and the quantity of the trade, and then we'll categorize it as this is typical of a small retail trade. Or we'll take a look at a different trade where we see the quantity looks, this is typical of a very large trader. And by creating our own tags, our own categories, now we created these buckets for further analysis. So we could compare what are retail traders doing and how they're using options versus maybe very large traders or institutional size traders.
Once you've done all this analysis, how can the investor use this data to help form their trading decisions?
The two main ways is once you understand, one of the things is you do want to understand, well, how are people using it and how is it impacting the markets? And that may help you find and identify opportunities. The other way is to try to improve your own execution quality. So, for example, if you're looking to perhaps do a buy rate or sell an upside call, well, it's helpful to see where you could generate the best quality execution, the best price. Where is there perhaps an implied volatility pump on the bid, or where you could get filled at a favorable price or near the midpoint, maybe even near the ask price. And that adds up and makes a big difference when you can improve your execution quality and find where the options that are more favorable to what you're trying to do.
Most of our listeners definitely understand market sentiment. Obviously, like if this analysis is pointing them to, say like a bullish move or a bearish move. And definitely a lot of them understand execution quality, but I want to kind of dive a little bit deeper into that because it really is important and it's maybe not necessarily as obvious to some people as it should be. A lot of people look at like commissions and they'll say, oh, okay, this costs $1 to go here, but $2 to go there. And that's all they'll think about. But what they're not really seeing is like this execution quality. So if they're able to buy the option for $1.03 at the place that it costs $2 versus $1.07 at the place that it costs $1, it's actually better to pay the $2 and the $1.03 versus $1.07. So why is it so important to the investor?
One of the things as at least a professional trader is that you focus on many things, your models, your risk management, but execution quality is another component that you keep track of, you keep metrics, and you want to make sure that you're efficient and that you're getting good executions. And I'm not talking about just the commissions, but the quality of the executions. And just to give, maybe to give an analogy, if I am a real estate investor, and as a real estate investor, I might need a mortgage. So I would want to know, what are the different terms out there? What are the different rates out there? And where do I go to get the best mortgage that suits me? Or where do I get the best insurance to insure my real estate? So those things add up over a long period of time. And the difference could be, well, if I'm looking at an option that is $1 to $1.10 and I want to buy it, I could go and I could buy it for $1.10. But if I could find a similar option, or I discovered that, wait a minute, I see that this option on this particular exchange has been trading below the midpoint and it's been doing it a lot, and I try to direct my order there and I get filled at $1.04 instead of $1.10, that's a 6-cent savings. It might not sound a lot, but percentage wise, it's almost a 6% savings. If you're looking at, your return on investment, it adds up, especially if you're doing it over and over and over. So the quality of execution is one of the important components that traders will analyze and seek out. And a lot of times you're willing to even pay to get better quality executions, pay brokers or route orders so you could receive a better quality of execution. And that's part of that analysis. Well, we're looking at all the trading activity, and there are all these different options, and some options are similar. It could be a strike away. If I'm seeking to do something, what type of execution can I expect on this option or that option if there's a lot of trades going on?
Well, Will and Dmitry, this was great. You want to leave our listeners with any final thoughts before I let you guys go?
A lot of people get very excited and they want to jump right in, especially when you're seeing things moving around. But I think it's important to step back, take your time, and really go through your analysis. Because that will help you really understand what's trading, what's going on, how it's impacting the markets. Is there an opportunity here? Can I identify what the opportunity is? How do I improve my executions? These are all important aspects or factors that contribute to the success of trading. And I think that if you could step back and go through those steps, you'll see greater success.
This has been a great podcast to go along with a great webinar you guys just did. For our listeners, I want to remind them they can find more content from Market Chameleon on our website under education. Just look for our contributors. Once again, guys, great having you here, and I look forward to our next podcast webinar next month. Thank you.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. The following podcast contains options-related material. Prior to listening to today's podcast, all listeners should read and familiarize themselves with the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the podcast description page. Multiple leg strategies, including spreads, will incur multiple transaction costs.